Didn't the Fed used to kind of follow behind the 10-year Treasury for the longest time?
Yeah.
And it's kind of where the market really set the rates, and the Fed kind of just followed along behind that.
Yeah, if we think about interest rates, I think this is important for people to understand. An interest rate is the cost of transferring savings and consumption over time. I want to spend today, and so I'll borrow from you, because you want to save today. And then the question is, how much do I have to pay you to borrow that money? Well, you want to be protected against inflation. Mm-hmm. You could do something else. You could open a dry cleaner, or lend it to your cousin who's building a house, or or invest in a stock. Right. There's a million things you could do. So inflation and a real return is what you want for lending me money. Mm-hmm. It's risky, so you ought to get paid for it. Well, the Federal Reserve set that interest rate at 0, and that's that, and they were able to do that because they now control the rate, not the market, and so that's the problem with interest rates. Where should they be? And the rule of thumb all throughout history is interest rates should be sort of inflation plus 2%, inflation plus 1%. Well, when we're holding rates at 0, we're way below that. And that's why the Fed has to lift rates, because they've been artificially low for a long time. But because we live in this new weird monetary policy, no one knows exactly what these rate hikes are going to do. And by the way, they're still way below inflation.
Right.
So the Fed, technically, I would say, isn't even tight yet. Right. Believe it or not. And I know they're a lot higher. I mean, I know mortgage rates went from 3 to 7. So everybody's like, I can't buy a house. Right. And but really, mortgage rates should probably be higher. Yeah. Because you're borrowing at 7, inflation was 7. Right. So that's free money. Right. Like that's and so we are, because of what they did in COVID. And by the way, we've never done these things. So part of forecasting is looking back at history, knowing the models of we've done things we've never done before. And so right now, forecasting is really hard.
I imagine so.
Yeah.
You got COVID weird numbers,
right.
The economic numbers are just they're warped right now.
Yes, they're warped. They're distorted out and so I don't use that as an excuse, because we can look at things, but that's why the morphine's wearing off, and people can decide whether they believe me or not. Right. But the point I would make is you can't shut down the economy and then artificially make it grow. And remember, we lost 31 billion hours of labor. That in the lockdowns, and now we're finally back up to where we were employment-wise. But that big hole, 31 billion hours of work that didn't get done. Right. And because we had all the morphine, we didn't feel it.
Interesting.
I just feel like I shouldn't use feel. I know we're going to feel it. The morphine's going to wear off, right. And your leg is broken. You know?
That's interesting. 31 billion hours. I never looked at that. Yeah. That's a lot.
Work that didn't get done, and we paid people anyway.
Right. So interest rates, we probably see another 75 basis points in December. Yeah. What's your outlook there?
Yeah, this is the craziest thing. So there's 12 people sit around a table in Washington, D.C., and they go, well, what do you think? Another 75? How about 50? Anybody 25? And they're like, I think they probably do 50 to 75. Mm-hmm. They will slow down here because rates are now, I mean, they have changed their opinion on, if you go back to the end of last year, they were only going to raise rates 3 times this year. Yeah. And they've ended up like 325 basis point moves. Yes. And they've now moved rates 11 times, basically, if you really look at a quarter point move. Yeah. And so they don't even know where they're going to end up. But I would argue that if they get interest rates close to 4.5 to 5, that they're going to start getting very nervous about how that's going to impact the economy. So they'll probably do 50, maybe 75, but then they will slow down.
And so the reason they're raising rates is because of inflation, right?
Right.
But we don't think that that's going to solve the inflation problem.
Right.
It comes back to M2,
Right.
money supply. We've got too much money chasing too few goods, the very definition of inflation.
Exactly.
Why is the Fed not talking? Why is there nothing out of the Fed talking about the money supply?
Yeah, because they want to ignore it. Remember, they were the ones who said inflation's transitory. It's not going to stay long. I was looking at M2, but the money supply, how fast it was growing. I said, we have to have inflation, and then it came. I'm not trying to pat myself on the back.
No, you've been at Word Go. You've been talking about the money supply. Yeah.
Milton Friedman taught me how to analyze the economy, and you look at M2,
right.
and it's now slowed down. All right, so that's good news. It may bring inflation down in the future, but all this interest rates themselves can't stop it because. Here's what everybody says. The reason we're raising rates is it's demand destruction, what they call it. So if you took any economics or understand it, there's supply and demand. And so if you destroy demand, then that should bring inflation down, right? Well, just today, we got the housing starts numbers. And from their peak this year, the housing starts are down 21%. So that's the problem with interest rates. You destroy demand and you destroy supply. So fewer people are buying houses, but fewer builders are building them too. And now they're completing the ones they already started, but they're not starting many new ones. And so when you take demand and supply down, and then that's pretty simple, then it doesn't change inflation at all.
Yeah.
So it's really not. Rates can wreck the economy. I have no doubt about that. But just because you wreck the economy doesn't mean inflation's coming down because demand will come down and supply will go down too.